Hello, you're watching Smart Money. Welcome to it. Well, if we're certain about one thing, it's that markets both locally and globally have become accustomed to uncertainty, right? And the heightened volatility it brings with it. And with that, investors are paying a bit more attention to structured products to help diversify their portfolios. So today, we're catching up with James Cook, product specialist at Investec Retail Structured Products. James leverages his expertise in investment structuring and sales to develop innovative investment solutions tailored to both retail and institutional markets. James, thanks so much for joining us today. So, right at the top, for those who are perhaps unfamiliar but are looking for alternative investments, what are structured products and what role do they play in an investor's portfolio?
Hi, Alishia. Thanks for having me. So a structured product is generally a listed instrument that can be bought into a normal stockbroking account. It's an investment that is linked to the performance of a different asset. So our team focuses on what we call equity structured products. So these are investments that are typically linked to large equity indices. So they generally have a level of capital protection. So if the underlying index performance is negative, then investors would have an element of capital protection. So they'd either get all of their money back, or some products have some level of risk where you could get a portion of your money back. Then on the upside, if the equity market does well, then these structured products would participate in that equity upside, usually based on a formula that is determined upfront. So I guess a typical example of this would be a geared growth kind of product, where whatever the underlying index does, investors would get a gearing factor applied to that. If the market grows 10 and the gearing is, say, 200%, investors would return or get 20% on that structured product return. Generally, there's about a fixed term for this investment. So there's a defined entry and exit point. It's not like a unit trust where you can make periodic investments into the product. It's generally one fixed amount upfront by the application deadline, and you let it run for the term of the investment.
Well, looking at its 22-year track record in the structured products space, James, Investec realizing positive returns on 96% of the public products it's launched. So what would you say differentiates, the structured products Investec has on the table?
Sure. When our team was started, structured products had a bit of a bad reputation, and our team very deliberately went about trying to rectify those misconceptions and that bad reputation. So we had a very strong focus on transparency, really showing what went into the structured products and the underlying financial instruments. A very strong focus on fee disclosure. We have all of our fees built into the product, meaning that whatever we market to investors is already after all fees, costs, and expenses. So there's no surprises later on where you get a payout that's less than what you thought it would be. Also quite a strong focus on ensuring that there's liquidity. So if you need access to your funds before maturity, then that's an option. I think all of this has come together to make investors have a sense of trust in the products. And because of this, the products have become, I guess, a core part of a lot of investors' portfolios. I think that we also have quite a history of releasing innovative structures and technologies. And this has kind of helped us stay ahead of the curve and unlock quite a few efficiencies for the end client. But I think maybe the main thing for us is, as you said, we have this 22-year track record, and no investor who's invested in one of our public products has lost any money over this 22-year period. And because of this, we have this focus on trying to keep things simple and err on the side of conservatism. We don't want that track record to be tarnished, so we're quite conservative with what we release to the public.
All of that said, James, you're launching now 2 new structured products, right? Both of which are linked to the Shanghai Shenzhen CSI 300 index. And we'll get into the details of them in just a bit. But first, why has this market now become a key focus for Investec?
Sure. So I guess the CSI 300, that's an index that's linked to the Chinese equity market. It consists of the 300 largest and most liquid companies in mainland China. And if you look at that index, so since its high in February 2021, it's now dropped 31%. Whereas if you compare that to other major markets, it's gone up significantly, like the S&P 500, Euro Stocks 50. Those have all done pretty well over that period. So from an entry into the market point of view, it seems like a pretty decent entry point. Then from a valuations point of view, so if you look at things like price earnings ratio, price to book ratio, it looks comparatively well valued compared to the likes of the S&P and Eurostoxx, for example. And then finally, from a diversification point of view, I think a lot of South African investors, for their offshore exposure, they typically have a focus on developed markets and quite limited exposure to countries like China. So if you can buy or obtain exposure to this market through something like a structural product, that helps from a diversification point of view, especially considering the fact that there is quite a low correlation between the returns of the CSI 300 to the developed markets compared to how those developed markets are correlated to each other. So that really helps from a diversification point of view.
But you're clearly seeing upside potential as we move forward, right?
Yeah, definitely. I think that the fact that there is a little bit of a sentiment issue towards the market at the moment really helps the fact that there's a decent entry point. But if there's any form of shift in that sentiment, we could see quite a significant return if investors, start going back into the market. We have China being the second largest economy in the world, with a very big focus on innovation and technology at the moment, and they're making significant pathways forward on that front. So I think for people that typically have all their eggs in one basket, it might be worth making a bet on a country like China. And if there is that turnaround, then the returns could be quite attractive.
Okay, so James, let's talk through some of the key differences between the two products themselves now. And if we get specific here, because, we've picked up that the one involves investing in rands, the other in dollars, but it comes with a few other key differences as well. So perhaps talk us through some of those and then the pros and cons of each of these options and what investor type each of them is targeted at.
So we have two offerings. Both of them are 3.5-year investment term products. The RAND version and the dollar version, we like to just introduce two offerings with these different currencies just to allow investors to make a choice based on their view on if the RAND would depreciate or appreciate. So that just helps with, aligning to that view. The RAND version, this one, I guess, would be more on the conservative side. It has 100% capital protection at maturity. So if the market drops, it doesn't really matter how much it drops by, the investor will get 100% of their initial investment back. Then at the end of the term, if the index is either at the same level or higher than it was at inception, investors jump straight up to a 30% return in RAND. That's equivalent to roughly 7.8% compounded each year. But the whole idea behind this investment is that you want exposure to the market if it does recover. So what happens is that if the return of the index is more than 30%, then you also get the upside above 30%. So it's actually uncapped on the upside, right? So that's the one option. The dollar version has a bit more risk from a capital protection point of view because it has what we call a barrier. And that barrier is set at 60% of the initial index level. So what that means is that at maturity only, if the market is less than 40% down, so it hasn't breached the barrier, you get all your money back. But let's say it's down 45%, it's now breached that 60 barrier, so you would have a 45% loss. So that's from a capital protection point of view. On the upside, the dollar version has geared growth. That's the type of product it is, meaning that whatever the index does, a gearing factor will be applied to it. In this case, the gearing is 190%. So let's say the market goes up 10, then the product will return 19%. But that underlying index growth is capped at 40%. So if it gets to 40, then you still get your gearing on that 40, which means the maximum return for the product is 76% in dollars. And that's equivalent to 17.5% in dollars. So while the upside is capped, it's a fairly high upside in dollars, and most investors would be quite happy with that. Then in terms of capital protection, because obviously this is a very key part of a structured product, the nature of the investment is a note. And this is essentially a promise by Investec to pay out based on the formula. So the investor has credit risk on Investec as the issuer of the note. But on top of that, what we've done is linked it to a secondary level of risk. So the RAND version is linked to Societe Generale, and the dollar version is linked to Commerzbank. So what this means is that we earn additional interest for taking on that risk that allows us to boost up the return that we can offer to investors. But there is this element of risk. So if one of those banks has a credit event, a portion of the investor's capital could also be at risk. However, this is all at senior unsecured credit ranking, which is the same level as being a depositor with the bank, and or I guess the international banks are investment grade rated. So it's important to be aware of the risks. But I guess from a relative point of view, you're already taking investing risk. So this, I guess, helps boost the returns without too much extra risk.
So as you say, while there is significant opportunities and pros to this, investors needing to be cognizant of the cons, and in this instance, in the form of the risk that comes its way as well. I know that you've been quite emphatic about the fact that we are looking on the dollar option as a geared growth opportunity, and I just want to double click on that specifically when it comes to, James, what investor type this would be targeted at. I mean, when should investors consider this approach versus the other?
So I guess the geared growth would require the investor to have a bit more of a bullish view. You need the underlying index to actually perform well in order for your gearing to be meaningful. So if the market grows and you get that gearing, then the return can be quite high. And as mentioned, the upside is capped at 76%, which is quite high over a 3.5-year period, right? So the RAND version, you don't need the index to do very well to get a decent return. It only has to be flat or positive at the end of the term to get your 30% return. The RAND version does have unlimited upside though, so I guess that could be attractive to not have that cap. But the dollar version, while capped, is still a pretty decent return over that 3.5-year period in dollars.
Okay, so that outlining then some of the incentive, but if we have to wrap things up properly, James, and with a final point here, what potential returns are investors likely to achieve with these two products across their 3.5-year investment terms?
Sure. So as mentioned earlier, the dollar product has a cap, so your upside return is capped at 76% in dollars. So what's really nice about structured products is that when you enter into the investment, the scenario analysis is presented upfront. You know what the potential could be depending on what the underlying index does. Now, we can't say what the underlying is going to do. We've chosen it because we think it has return potential, but we can't predict what's going to happen in the future. But what we can say is what the product return will be depending on what the underlying return is. So you either get a portion of your money back if the market drops, or you can go up to a max return of 76% for the dollar version. For the RAND version, it's even more difficult to say because it's unlimited on the upside. So if the market really does well, then you could participate fully.
Okay, so what are these products' minimum investment requirements, and when will this investment opportunity close?
So for the RAND product, the minimum investment is 100,000 Rand, and then $6,000 for the dollar version. And we are currently marketing the product, and they will close for applications on the 13th of August.
Okay, so pretty soon. James, let's leave it there. Thanks so much for having joined us today. James Cook is, of course, with Investec.